All right, everybody, welcome back to part 2 of Round Table Prime 2024. I'm Jeff Sherman here at the DoubleLine offices with our distinguished panels that you saw in the first part of our series today. And this is the second segment that's going to focus on markets in 2024. So with that, Charles, I wanted to start with you. What do you think about the market right now in 2024 after this uplifting introduction from Danielle?
Well, I'm saying if you didn't buy firm stock, you missed out. I made a hell of a run. The buy now, pay later thing is definitely worrisome. It will get me into one thing, though, that it's going to be interesting this year, and that's the pipeline, the IPO pipeline. Silicon Valley, the VCs, they're in trouble. They're in a lot of trouble. That's why they bailed out Silicon Valley Bank. Not the bank, but the depositors. Yeah. Many of them, they're up and coming companies. It was really just completely a gift to Silicon Valley and venture capitalists. They're going to try to shove some of these things. Klarna, the reason I thought about Klarna is sort of one of the big pioneers in the buy now, pay later space. I think its market cap at one point was like 80 billion. It's probably down to 57 billion. So beware, that's all I'm saying. The few IPOs that came out last year, I mean, Birkenstock, okay, but
that was Barbie, though, right? That drove that, right?
But
well, like I read originally, like the talk was like $5 billion on the IPO, and then after there was the pink Birkenstocks in the Barbie movie, the valuation turned to $8 billion all of a sudden.
Right.
As ugly as they are, I bought two. Not for me though.
Because one of the biggest rip-offs of the general public when it comes to the stock market has been the IPO market for the last 15, 20 years. And you see it all the time. You go back to when IPOs were really hot. Maybe pre-2000, company would go public at 35, open at 50, and go to 75. What was the chatter on financial media? Look at all the money you left on the table. So of course, Mark Zuckerberg. They increased their IPO allocation, widened the allocation, increased the price. They kept taking the polls, putting a finger in the wind. Until it went public at the max. They took every nook and cranny, every nickel they could from the general public, and the stock opened down. And of course, that was a disaster for a while. But that's going to be something I'm really worried about with respect to just the regular investors out there, household investors, who a lot of the times in these private valuations are being created, artificially created. The money that they do raise is being used to make them a household word. So you get back to the Peter Lynch thing. Oh yeah, I've heard of Klarna. So you end up buying a stock at the opening day that never gets back there again. That's been a real frustrating point for me. Listen, it's cliche-ish, but as far as equities are concerned, stock pickers market again, probably more so this year than even last year. It's on one hand, you've got the whole AI phenomena, and which, by the way, is going to plays a big role in all its productivity things and employment too, right? It'll be more prevalent this year. But on the investing side, I'm trying to be nimble. My word of the year for our investors, my piece that I put out on January, the first Tuesday of this year, was nimble. It's hard to be a long-term stock investor unless you're prepared to take some incredible, swoons. I was in NVIDIA when they reported their earnings 2 earnings ago. It went from like 450 to 500 back to 450. Reported another earnings report, 450 to 500 back to 450. I had my clients take profits on it yesterday. It finally broke out. I sold into strength. There's some numbers out there, 600, 700 bucks. But there's some amazing companies. We are really in the midst of, this is the 4th industrial revolution. There are some really, when I say transformational companies out there, software as a service, those SaaS stocks, some of them are so attractive. Mungo, Monday, MNDY, Snowflake to a degree, Services Now to a degree, and just phenomenal. But the volatility is outrageous. So I like owning. I like Hershey's here. I think it's got a great dividend, little downside, pricing power. I like Walmart. Walmart is one of my tech plays. They got the largest army of drones out there. They never paid any attention. Walmart and Amazon, they never paid any attention when the government was like, yeah, we're not sure. They like, yeah, okay, right. So we'll all be getting drone deliveries from Walmart at some point this year. You're just going to have to be nimble. I don't ever try to predict where the market's going to go. The S&P 500, it really is irrelevant to me because I try to zero in on individual opportunities.
Okay. Jim?
feeding off of what you just said, I had been an advocate that probably from mid-2000s until very recently that stock picking was a dead art form, just buy an index. And now I think in the post-2020 era, stock picking is coming back. And I think it's part of this idea that we are in a new cycle. We are in a transformative cycle with AI and everything else. It's no longer just buy the index or just not sell the index. Now, it appeared to work last year because 7 stocks, which were 30% of the index, accounted for the vast majority of the gain in the market. But markets tend to be cyclical. There'll probably be a period where 7 stocks will just destroy the index, and you could have just gone back to Portnoy's Scrabble bag and been better off in one of those 493s along those lines. So I do think that the dispersion of returns is going to come from that. But after that, I want to focus on the bond market a little bit. I've also been operating under the opinion that when the 10-year yield hit 50 basis points in August of 2020, that was the end of the 40-year bull market in bonds. We are now in a multi-year bear market in bonds. Well, the good news about that is that we've already had the most painful part of it, and it's done. Ed McQuarrie, who's a professor at Santa Clara, has got bond returns back to the 1790s, and the total return from 2022 and 2023 was the worst since the Civil War. Yeah, the American Civil War. But that's behind us now. And as Jim Grant likes to say, that he runs the newsletter Grant's Interest Rate Observer, it's nice to have an interest rate to observe again, because now that we actually have a yield, there's a yield to be managed, and bonds are no longer about capital gains anymore. And so even though I say it's a bear market, I do think, though, that there is still a lot of opportunities within a rising rate environment because there is a big, hefty yield in the market. So I think rates are going to go higher this year. I wouldn't be surprised. In fact, I'm forecasting that the 5% in October was not the peak for this cycle, but it's always been the case with rates. It all depends on why they're going to go higher. If they're going higher because economic strength or the economy is going to be trend growth and maybe a little bit better, throw in a little bit of 3% inflation, that's not so bad, as opposed to they're going higher from what I said in the previous segment about the UK, that we're putting our foot down and we're trying to kill your budget. That's not a good reason for them to go higher. So in and of themselves, rates going up or rates going down doesn't imply a good or bad scenario. It depends on why. And my scenario is a little bit more optimistic that the economy is going to hold in there a trend, maybe a little bit above trend. Now, things can happen that could change that equation, and I'll adjust accordingly. But I think that you could see rates go up. The dollar, I think the dollar, 2 things about the dollar. One, last year was a big story about, the end of the dollar as a reserve currency. And that was a little bit premature. To paraphrase, Winston Churchill, the dollar is the worst reserve currency ever designed except for all of the other alternatives. Give me an alternative to the dollar, and then we'll talk about it ending its dominance as a reserve currency. Well, we're all going to rush into the euro. We're going to rush into the pound. We're going to rush into the Chinese yuan. They don't even rule a law yet, and they're not even completely convertible. We're not going to rush into Bitcoin. Maybe in 15 years, if they fix a lot of problems with it, that might be an alternative, but it isn't an alternative today. So the dollar will continue to remain its reserve currency status. So in the higher rate environment, that should probably be somewhat constructive for the dollar. And then finally, to throw in with the commodities markets, if my scenario of the economy being okay, the other story that we had last year was everybody, and I'll use some technical language, everybody crapped all over the Chinese economy for good reason. It was really poor. It was really poor, but I think it might be bombed out. I'm not going to recommend Chinese stocks because there's a lot of issues with Chinese stocks. Again, rule of law and a lot of other things you have to deal with. But if the Chinese economy was to get some kind of a recovery, I'm not saying it's going to get better. It's just not going to. It's going to be better than it was, but maybe not a boom. That should produce a lot of demand. China is the manufacturer of the world. They suck in raw materials and they push out finished goods. And one of the biggest problems we've had was they were sucking in raw materials and pushing out finished goods, everybody but themselves, because their own economy was not doing so great. But if their economy does better, then I could definitely see maybe some kind of a bottom and a turn higher in commodity markets.
So Jeffrey, on the idea of valuation, we've seen since November 1 what people are coining the everything rally: rates, spreads, stocks, crypto. Maybe the dollar is a little weak since then, maybe just a little bit. But where are you in terms of this thing, thinking about, I mean, you put on your fundamental hat, you're a valuation guy. What are you thinking about these various markets globally?
Well, I think the most interesting results of 2023 was entering 2023, the forecast was, as it always is seemingly, that earnings would go up by 11% and ended up going up by 1%. And yet we had this huge year. So it's all valuation. There's nothing fundamental on earnings about it. And now we have a very high PE. It's very similar to 2 years ago, which led to some pretty nasty stuff. And if you don't get that 11% earnings growth, I just don't see how you're going to make any money broadly there. I still think we're looking at a recessionary situation. So I think you start the year, well, the way we've been positioning for a couple of years, we've been gradualistically de-risking in terms of lower credits in bonds, systematically until third quarter or so of last year, increasing duration. For the first time in the history of DoubleLine, our strategies had durations that were the same as an index fund, maybe even a tenth of a year, something trivial longer. I think you stay with that. I think I talked about the bond on Fed Day, November, was it 1st or 2nd? Can't remember which. But I said, I think we got a rally going here. And what was holding things back was rising real rates, interest rates going up, and there was no relief. It was just kept happening, and all of a sudden the fever broke, and so that allowed for the valuation of equities and the everything rally to occur. I think at this point, I think on a risk-reward basis, you stay with higher quality. I think treasury yields are going to continue to fall in a Pavlovian type of sense, and that is that as the economy weakens, people say, I've seen this movie before. Economy gets weak, inflation relaxes, bond yields go down. And I think that has clearly been in place since the first part of November. And I think that mindset will continue. But my biggest thought for the past, 3 years, 5 years, has been, what if everything that we think we know, because we've been around for 40 years and got all this experience for all these cycles, what if what we think we know is informed only by a secular decline in interest rates, where you had a nonstop secular rally interrupted by a few cyclical backups. So everybody thinks they know how the system works. But I agree with Jim that interest rates have bottomed. In fact, the title at my grants conference speech was a reprisal of the title I used in 2016, when rates put in what may be kind of the bottom other than the whole COVID stuff. And the title was Rates Will Never Rise. And that was facetious. And I used the picture of then Cassius Clay, and was it Sonny Liston? Yeah. And he's on the mat, and everyone thought that Liston was going to win, and there he is. And it looks like Liston's not getting off the mat, so rates can never rise. And I started to see echoes of that, certainly in 2016, and then back in 2020. Rates will never rise. And yet they've been rising quite a lot. We've blown through that secular downtrend by a lot, but we're now in the counter-trend cyclicality of rates falling. So I think that's a good place to be. But then I think when the recession comes, you want to really start to think about risk-taking, start thinking about the fact that the response to the recession, in my view, will be a dollar weakener. We all think we know the dollar does well in a recession. Well, that was over those past 40 years. What if the response to the recession is money printing, more checks? What if it's a budget deficit of 20% of GDP? I don't see the dollar doing well in that environment. And so that would be finally the moment where you want to shift for real to non-dollar. And I think the best case would be the emerging markets at that point in time. I think the dollar's going to go down. I think it's going to go down a lot in the next recession. And so you want to be protected from that. So for now,
I don't think it goes down prior to the recession. It's during. And
I think it's the response to the recession. Yeah. So the dollar has been weak. It went down last year. The peak of the Dixie index was 115 some time ago now, and now it's like frozen at 102.5. It seems to have almost no variation from 102.5. I don't think we're going back above 115. And the secular trend of the Dixie index has been in decline for decades. It's lower highs. And the most recent low was at 80 or so on the Dixie index. I think we're going to take that out. So that's more than 20% decline. So you're going to be better off in non-dollar. We started to diversify away from U.S. stocks after the pandemic around 2021. First we bought Europe. It hasn't worked, but it hasn't not worked. They've done the same, basically exactly the same. And the trend of U.S. outperforming non-U.S. stocks has been in place for a long time, particularly versus EM. It's been a very long trend. And it seems like that trend has been broken. And we're seeing a lot of signs of lack of momentum on the relative value of U.S. versus, say, Europe. And so I think that that's going to be part of the dollar decline, that the non-U.S. will outperform. So you're going to get an opportunity to buy credit, lower tiers of credit during the recession, but I wouldn't be there now. So we've been using a mix of treasuries, guaranteed mortgage securities, and sort of middle part of the capital structure, AA, single A, triple B, maybe some double B, but not below there. And if you look at the pricing of the credit markets, you see that it is blatantly clear that the market participants believe there will be significant losses on CCC securities. I mean, the yields are like 15%. So there's no way that you can come to a conclusion other than the market's pricing in defaults. And there's going to be defaults. There's going to be defaults on some of these middle tier revolving borrowers because they've already had a 425 basis point increase in their coupon, and they're going to have problems when the economy softens. So you're going to get that opportunity, but I want to stay away from it at this juncture. And then for the long term, and I've been saying this every year, and I believe it now more than ever, just buy it for your grandchildren's college fund, the Indian equity ETF, and don't worry about it because it's going to go up. It's going to be a 10-bagger, just like it's exactly where China was 30, 35 years ago. And you knew 30 years ago that China had to absorb hundreds of millions of people into the labor force, movement from the rural to the city and all this stuff, and they had to change things to accommodate that. That's where India is. And I think I heard someone talking about phone manufacturing in India and so forth, and that's all part of the same story. So that's my single favorite thing to own, and I don't even look at it. I don't look at it for months because it's a long-term story. So that's sort of what I'm believing in.
Jeff, can I ask you about mortgages and real rate mortgage spreads? What's your view on those?
The mortgage market is another example of what you think you know from 40 years no longer applies. Because the thing about mortgages is people think, well, if the economy's going into recession, there might be defaults. Well, that could theoretically be true on non-guaranteed mortgages, and you could take losses. But the housing market is up so much over the past few years that many people's number one performing asset is the fact that they borrowed a mortgage. Mm-hmm. Their mortgages from 3 years ago, the price of the mortgage-backed security is down in the 70s, which means that if they default, yay. Mm-hmm. You want them to default if you're government guaranteed because you get 100 back. So one thing that's happened is that mortgage spread had gone very high. It was close to 200 basis points, and there was no risk because there is no default risk when you're down at the index was down at like 82 cents on the dollar. So typically the problem with mortgages for the past 4 years is you bought them and rates fell and you got them called away from you and had to reinvest at lower rates. It's called negative convexity. It means that for symmetric move in interest rates, you have very little upside and a lot more downside. That's not the case anymore. In fact, if you get to the longer end of the securitized government guaranteed market, like longer term CMOs as we call them, they have very high positive convexity, and yet the spread is there. So it's a very, very good opportunity. But another thing that the 40-year where the secular trend changed, so many economists a year ago forecast that with rising interest rates, home prices would go down, and they did by a little for a short while, but now they're at new highs again. Why is that? Because there's absolutely no turnover. Because if you have a 3% mortgage, you don't want to borrow, sell your house, and take a 7% mortgage. Your payment would go up by 100%. Because with the combination of the home price increases and the cost on the mortgage. So we're in a strange situation where the housing market has actually been frozen. But the builders are starting to fix that. So we've seen home construction go up a little bit, but where there's home construction that's off the charts is multifamily. There's been a massive increase in the share of multifamily homes, and it's by far the largest put in place. And sure, they don't come online in a year, but they started building them a few years ago, and they're starting to come online, and this is going to put negative pressure on rents that have gone up. And you see that in
672,000 units to be delivered in 2024, the highest since 1974.
Right, and we see the apartment list indices and the Zillow rent index, they were way up there. One of them's negative now, the other one is at 3% year over year. Not sure why they're different. But that's going to put downward pressure. And what might be really counterintuitive is if interest rates fall, as I expect, and mortgage rates come down, you might weirdly see home prices go down because it might unlock some of the supply. So again, everything that you think you know is informed by 40 years of declining interest rates. How about one more thing? How about high yield bonds? Do we really know how high yield bonds behave? Well, the high yield market started when rates were at their peak. Basically, in the early 1980s is when it really started. And every time you went into a negative economic environment, you had default risk, but but the company could refinance the debt at the lower interest rates that the recessions brought. So what if so how many high yield bonds have really matured over that 40-year decline period? Not many. They either defaulted or they got refinanced. So what happens when they can't refinance them anymore because interest rates are rising? Well, I'm going to go out on a limb and say defaults will be higher than we've previously experienced. And that's going to be something that you need to take into consideration because the high yield spread today on the index broadly is about 3.5%. That's about it. It was up near 6% not very long ago. It's down to 3.5%. And the credit market right now to start 2024 in bonds is just booming. It's like the good old days when deals come out and they're 20 times oversubscribed. There's a lot of people that are taking a look at the new year and they're going into these riskier bonds, and it's getting late. It's getting late in the game because
June 2007 was the last time we had spreads this tight.
Yeah, they're very, very tight. And with a recession potentially coming and the inability to refinance being a factor in the game, I'd watch out for that. So that's another thing about the 40 years that maybe the next 40 years will be different metrics, and I expect that'll be the case.
Tips? You have a quick word on tips?
Tips haven't really done much of anything. I think your inflation view, you should probably like tips. I think that tips are really not the place to be now. I'm pretty sure the inflation rate in the short term is going to have a two-handle on it. I'm pretty sure based on the WTI and based upon the commodity prices that can't get above their 200-day moving average for the past 18 months, the lower oil prices, all these are symptomatic of global slowdown. So I think the inflation rate is going to be at 2.5% on the headline CPI by the middle of this year. Now, will it stay there? I don't know. But that's what we're looking at for the visibility that we have is typically on these things about 6 months. And I am not involved in tips at this point.
Rosie, what do you think about the markets too? We've heard your economic forecasts. Where do you recommend positioning for your clients right now?
Right. Well, I just want to respond first to something that Jeff just said. There's a reason why the Fed doesn't provide median projections on the CPI, okay? Because it's a flawed statistic. They do it on the PC deflator. And everybody's wondering, how come the bond market didn't get smoked today? Because we printed plus 0.3 on core CPI. Well, I got to remind everybody that we printed plus 0.3 on the November core CPI, and the core PCE deflator came in at plus 0.1, for the second month in a row. Yep. Waiting for the inflation rate to grab a two-handle. Two things. The first is that the 6-month trend in the headline deflator, which is the superior statistic. I talked before about these gaping gaps between these different economic indicators. The headline PC deflator on a 6-month basis is already running at 2% at an annual rate. And the core deflator is running at 1.9. So we're there. And I'm not going to say that the Fed's going to overreact because I said before, once burned, twice shy, especially for this group. But it's the deflator that matters the most. Now, about the stock market, you know, look, this has been a meat grinder, right? Like, I think that it's been very hard on the bulls at any moment in time and very hard on the bears. You know, we're sitting here with the S&P 500, even with these magnificent 7 stocks, we're flat on a 2-year basis. We're flat. Is that good? Is that bad? Indifferent. You're supposed to really make money in the stock market since you're putting capital to risk, which you don't do in the treasury market.
It's been better
so
than bonds.
it's been frustrating. Yes, it's been better than bonds. However, it's a different, you know what? But it's a different calculation because you don't have capital risk in treasuries. You have other risk. You don't have capital risk. And treasuries, you know exactly what you're going to get paid at the end of maturity, and you don't have that luxury in the stock market. So it's almost a false comparison. They're two different risk characteristics. The point that I'm making about the stock market is, as Jeff Gundlach said, we're flat on a 2-year basis. And it's not even as if the valuations have improved. And in fact, the most important valuation is the relative valuation, which is the equity risk premium. So when people ask me, what drives my views? Well, a bunch of things. And we know the stock market is a momentum and sentiment beast. There's a lot of psychology that goes into the stock market. Psychology does not go into the bond market. You've never heard anybody in the bond market say TINA. There's no alternative. That came from the stock market. You don't hear anybody in the bond market ever say FOMO, fear of missing out on a bond rally. That's from the stock market. The cash on the sidelines, dry powder. Do you ever hear anybody in the fixed income market talking about that? There's so much psychology involved in the stock market. But I pay attention to valuations, not because it's a timing device, because it's not, but it does tell you at any moment in time, do you have tailwinds or headwinds as far as expected future returns are concerned? That's why valuations are important. They are not timing devices, they are expected return devices. And what drives my thought process is always the equity risk premium, which is 100 basis points. The stock market relative to bonds, quite right, stocks have been a better place to be. Ergo, stocks are way more expensive than bonds are. And so when you look at the equity risk premium, 100 basis points, and then I invoke my hero, Bob Farrell, rule number 1, markets return to the mean over time. And he's not talking levels, he's talking ratios. All ratios mean revert. The equity risk premium is a classic mean reversion statistic. Historically, it's 300 to 400 basis points. We're talking about a 2.5 standard deviation event. And so I'm compelled, therefore, to believe what is that matrix that will equilibrate or mean revert the equity risk premium? What will put bonds and stocks on a more comparable valuation setting? Well, if you believe that today's level of the S&P 500 and today's level of the multiple makes you comfortable on a relative basis, the 10-year note would have to be 1%. 1% to make that math work. Now, that might work perfectly in your, well, we bottomed. Well, of course we bottomed. The 10-year note bottomed to 0.5. But I'm trying to say that if you're talking about mean reverting the ERP and you think you're comfortable with today's level on the S&P 500, the 10-year note would have to be 1% to make that math work. Yes.
You might remember, you might not remember, 2 years ago, I went through a thing and I talked about how versus its own valuation history, the S&P 500 was top percentile, top 2 or 3 percentile in 30 different indicators versus its own multi-decade histories. And everyone thought, oh, here's this bond guy, you know, trashing the valuation of equities again. But I put that up as a straw man. I said, as rich as they are, they're actually cheap to bonds, to the 10-year Treasury bond. And so amazingly, bonds did terribly. They did about the same negative return as equities in 2022. But you're absolutely right. Now the bond yield is so much higher.
Well, we've gone
completely changed.
We've gone exactly the other way, and it's exactly the same extreme. So we can flip it around and say, if you like treasuries today at 4%, 10-year, then what's the S&P 500 that would equilibrate the ERP? And you're talking, we're going back to 3,300. Now, that's not a forecast, right? It's just a mathematical observation. Because the ERP, if you look at the chart, it mean reverts. So it's tough for me as a fundamental economist, that is a market economist, to look at the market right now pricing in this soft landing. The soft landing, we have been in a soft landing. The soft landing is real. The soft landing is the bridge, however, from the expansion phase to the contraction phase. The soft landing is just that transition. That's what we've been in. And you have all these people saying we're in a permanent soft landing. No, it's not. It's not going to be a permanent soft landing. 1979, soft landing. 1980, recession. 1989, soft landing. 1990, recession. 2000, soft landing. 2001, recession. 2007, soft landing. 2008, recession. It's part of the business cycle. Okay, and there's a whole bunch of reasons, and fiscal stimulus was a big part of it. Fiscal stimulus last year accounted for 2/3 of the growth in the economy. That's not being repeated this year. It's not being repeated this year. But the lags from what the Fed has done is going to continue to percolate. People think this game is over. I say, you know, the short memories, good grief. The Fed stopped tightening in the summer of 2006. And the recession started at the end of 2007. You know, there's just basically lags. There's just lags. And the traditional lag from the start of the tightening cycle to the beginning of the recession that nobody ever believes is going to happen is 26 months. They started tightening in March of 2022. The recession is probably going to be happening in the next several months. Again, what else do we have to go by except for history? And I guess we can always say what's different and what's the same. But you know what? The best economist who ever lived wasn't even an economist. He was a physicist, and his name was Albert Einstein, who famously said that the power of compound interest is the 8th wonder of the world. And we just came off the most pernicious tightening cycle since '81, but there's not going to be a recession. Interesting. No, it's basically when we go through this refinancing and it's just starting and it's going to cascade in the next couple of years. And there's no fiscal stimulus, and we had this conversation. There's no stimulus out of executive order, and the Republicans are not going to be quick to bail out Joe Biden this year. So that's going to be a bit of a problem for the economy. And I want to make this point if I can. You know, I had on my webcast last week this guy named Roger Lipton. who I heard speak time and again at Dick Strong Symposium that he has in Vail. Who's Roger Lipton? Nobody in this room probably knows who he is. He is the preeminent restaurant analyst in the United States. He covers every public listed company and used to be a restaurant owner like 30 years ago. Roger Lipton, you can Google him. I had him on my webcast. And here's what he said, because what is more discretionary than eating out? What is the thing that you can cut back the most or the first is going to the restaurant? You know what he said? He said that activity has become concentrated on weekends, Friday and Saturday. Monday to Thursday, nothing is going on. And he said, he says, in the past 3 months, the discounts and promotional activity in the restaurant industry is unprecedented in his 40 years in the business. He said that the consumer recession, and he's in the weeds. He says, what's happening, frugality, people are sharing plates. They're not getting a bottle of wine, they're getting a glass each. It's very interesting, the things happening beneath the veneer of these headline retail sales number. Tectonic shifts are taking place. And this guy, who's typically pretty bullish, said the consumer recession is actually starting now. Okay, so in recessions, earnings go down 20 to 30%. Consensus is plus 11. So I'm a little concerned about, because all you had, right, with the momentum and the excitement where all the analysts are raising their numbers in the past several months. The market broadened out, they're raising their numbers. Well, the analysts are going to be cutting their numbers. That's my big concern for long-only equity investors that are all in. If you have to be all in, and I share Jeffrey Gundlach's view, I'm probably more bullish on rates, but we will bring that up at the best ideas part of the session. I think that if you have to be all in on the stock market, back to Charlie Payne, that you want to be very selective, not be in the cyclicals. I guess you would say the growth stocks, if rates come down, they're the longest duration parts of the market. I don't like the valuations. However, I would say to be in the parts of the US stock market that are correlated with lower interest rates. So you're talking telecom, you're talking utilities. You could be even talking about selective REITs, but you've got to be selective given the...
REITs are already up a lot.
They're up a lot, but because of course, but you've got to be very selective. They're up a lot because a lot of this move has already happened. Telecom as well, right? However, utilities did not have a good year, and they're the poster child for... they're the bonds and drag in the stock market. So, and then I think, look, the bottom line is that the financials, the banks are trading very cheaply. Of course, you got to be careful because we're going through a default cycle. However, if I'm right on the Fed that they pivot the yield curve this year and we go to a positive sloped yield curve, and they're still trading the price to book, the financials could be a good place to be at some point this year. You'd be wanting to take a look at that. So that's my view for the stock market as an asset class. I'm bearish, but I would be bullish on the rate proxies within the S&P 500. We've done a ton of work. We've been bullish on India. I don't advertise it enough. You know, people view me as some sort of radical perma-bear, but you know what? There's more than, I mean, so the U.S. is what, 40% of the global market cap. There's another 60%. We've been bullish in India for the past several years. And in fact, what's interesting, Modi, notwithstanding what a divisive character he is, and he's probably going to win the national election, but I'm looking at the data, and I'm telling you, they are seeing a productivity-led growth. Inflation in India is coming down for good, and they're seeing a CapEx-led productivity revival there that has me very excited. Okay, they're being re-rated for the right reasons. So we've been long India. We like India and Japan, which is just broken out to fresh 40-year high. So Japan, this is the last leg of Abenomics. Japan's also being re-rated. Japan, you want to own Japan for the all-in cash yield, which is about the best in the world. You know what? They for decades, the term shareholder returns in Japan was an oxymoron. But now it's actually happening. So corporate governance, everything happening in Japan. Japan looks like the U.S. in 1982. There is actually an equity culture developing. So I would tend to say that those are my two favorite markets, Mexico as well, by the way. And I would say that I don't think China, I think China's in the penalty box for a long period of time. And China teaming up, for example, with Iran and Russia has put them permanently in a new penalty box. And so what's happening is that all these other Asian countries, including Mexico, are benefiting from the disinvestment. Global disinvestment in China is a big problem, but a big beneficiary. A lot of that's going to Japan, by the way.
How about Canada?
Oh boy. Look, I am. Oh, I should mention just one other thing. And one of the things I'd be bullish on Canada is uranium, by the way, and because you want to buy classic economic supply demand. There is supply deficiency in uranium, and you see what Cameco stock is doing, and I think that's a secular bull market. That's about the only part of Canada I could really say that I'm bullish on. There's going to be political change in the next couple of years, but not soon enough. It's a very poorly managed country, and it's a torque on global GDP. And the world is going into recession. It's not just the U.S. I think that Europe is already starting, in Germany, by the way. Canada is a small open economy, a torque on global GDP, and most of it's really the stock market there, Jim, is a barbell between commodities, which you don't want to own in a global recession, okay, outside of select few, and the banks. And you think there's problems in the U.S. banks with the corporate debt rollovers coming and delinquency rates and auto loans and credit cards? Canada, the housing market is in deep disarray, and all those bad assets are sitting on bank balance sheets. So I would say that Canada, not so much.
To the permanent soft landing, permanent's forever, right? Forever is a long time. So to say forever soft landing, I'd be so embarrassed to make that pronouncement.
But Pete, it's a soft landing, no landing, or no landing, or what's the new one, the hot landing. So there's all of a sudden there's going to be some catalyst for reacceleration and growth. Where's that coming from? But that's what I mean is that what we have to assess what's caused a lot of this momentum and short covering is the view that people have bought into the Wall Street economists' opinion that there is no recession. And if you have that view, then the stock market might just range trade. It could go up, but there's never been ever, not once, where we had a recession and the stock market didn't go down.
One thing no one covered, private markets, private equity, VC, you talked a little bit about that. Someone want to address views on private markets, especially juxtaposed against public markets?
So I think two things are going on here. About 5-6 years ago or so, public pensions were piling into private equity real estate funds, specifically real estate funds, and CalPERS started that trend. I think that 2024, you're going to see an acceleration of the WeWork effect, because you're actually going to hit the maturity wall in corporate credit, and that's going to actually, when I'm speaking to my contacts in commercial real estate, it's going to subordinate commercial real estate. Cap rates are going to get even higher than they are, because you're going to want to refinance the corporation before you're going to open up your balance sheet to refinance the building. So we're going to see an accelerating trend in CRE that is fed starting in the first quarter by corporate debt refinancing. I'm answering your question this way. If you're seeing 15% yields in high yield right now and spreads as tight as they are, can you imagine what the private paper is going to trade for? So some of your oldest, most and when I say veteran, I mean 20, 30-year actors in this space, in private credit, for them, if they have the experience, not some Tom, Dick, and Harry who just, I'm going to be a private credit shop today because it's very popular, but for experienced veteran players in private credit, they can take out private equity on the cheap in an interest rate environment where you actually have a default cycle. I mean, when I was advising Richard all those years ago, I was on the phone with Oleg Malenkov, who I'm sure you know. He's been the head of high yield strategy at Bank of America since the dinosaurs roamed. And he said he'd never seen anything like it, but the default rate cycle had been cut in half. And so companies didn't actually have to pay the piper. If publicly traded high yield companies are going to really see rising defaults this year, and we were just saying during the break that Dish is teetering right now, $20 billion of debt. But if we're going to see those kinds of defaults, it's going to be uglier on the private side because there's less liquidity.
One of the big problems with the valuations of 2 years ago, I talked about how equities were very, very high versus their history. And of course, bonds were ridiculous at negative yields with inflation coming and all that. That's the environment where money piles into private credit, because you can analyze bonds versus inflation, and you look at it and say, I want nothing to do with this. And you can look at equities at their high valuations and you go like, I don't know, This type of thing has not been a good entry point. So things that you can analyze, that you know about, or you think you know about, you look and say, I don't want the stuff that I know about. So just give me something I don't know what it is. Like, just take my money, put it into something, don't tell me what it is, because I'm going to be afraid of it.
Yep.
And that's what SPACs, remember the SPAC thing, and all this private credit, and then all of a sudden the public markets reprice, and some defaults start to come. It's like, uh-oh, because you don't even know that you're in something that absolutely has risk.
I mean, Jim is at ground zero. When you look at the most underfunded public pensions, they have the highest allocation to alternatives. And the highest allocation to alternatives is in Chicago and the state of Illinois pension funds. If Indiana presses through with passing no state income tax, I don't know who's going to be left in your state.
Not me.
We'll welcome you, Jim.